I'm Matt Bouchard with REIT.com here in New York City for REITWeek 2014. I'm joined by Glenn Mueller, professor at the University of Denver and real estate investment strategist with Dividend Capital. Glenn, thanks so much for joining us again.
Thank you.
Now, do you still consider REITs to be low volatility investments?
Well, historically REITs have been low volatility investments. During the meltdown of the market, if you will, back in 2007, 8, and 9, that volatility went up a lot. And it's because we had a new, if you will, derivative product called leveraged ETFs that really created a lot of volatility and brought REIT stocks up to almost as high a volatility as the overall marketplace. And a leveraged ETF basically buys double or triple the amount using leverage of a stock and has to rebalance every day. So it's not a investment vehicle, it's actually a gambling vehicle so that an investor can say, gee, today I think the stocks are going up, so I'll invest in this leveraged ETF that'll give me double the return for one day. The problem is they've never actually met that goal of giving exactly double the return. And over time, because it could be an up or down, they don't return double the return over a year or anything else. So they're not an investment vehicle, they're a gambling vehicle. That created a lot of volatility in REIT prices. As soon as the volatility in the market went away, as soon as the market went back to a normal trading, those leveraged ETFs became very small, no longer really affecting prices much, and REITs are back down, their volatility is back down to a, if you will, normalized level, which is normally in the 30 to 40% of the overall stock market. So they are publicly traded vehicles, but they are much less volatile historically than the overall marketplace in normal times.
And what about REITs' hedging characteristics as more of the market is incorporated into index funds?
Well, yeah, and I think more investors are using index funds, that type of thing. And more REITs are being added into indexes, which has a tendency to make them move that way. It used to be that you had individual investors and the focused real estate investment funds investing in REITs. Now you've got all these indexed funds and ETFs investing in REITs. That makes them move a little bit more with the market. But like utility stocks, they are higher dividend and much more stable in their earnings than most other companies. So from that standpoint, I think they're definitely a necessary part of any investor's portfolio as a separate real estate investment. As all my research and as I teach and talk to people, real estate really is a separate asset class that should have a separate allocation in every investor's portfolio.
And looking ahead to the second half of this year, what are some of the key economic indicators that REIT investors should really be keeping a close eye on?
Well, again, I start my first class with, real estate is one of the three major factors of production: land, labor, and capital. Every business needs a piece of real estate to operate out of. And so, number one, absolute key is employment growth. If you have good employment growth, every time someone gets a job, they have to have a place to work, and that increases demand. And since the second quarter of 2010, when employment turned positive, demand for real estate's gone up, and we've seen occupancies and also rents in all the major property types move up. So number one is employment. GDP, very important as well, especially in hotels and in industrial. So those two, those are the two key factors that every investor should be looking at: are employment growth and GDP growth.
Glenn, thank you so much for your insights.
Thank you.
For more on this and other REIT news and analysis, be sure to visit REIT.com.